Bear markets, they're scary, right? Like let's just be real about that. Watching your portfolio bleed red and feeling powerless while waiting for a recovery, it sucks. But there is a better way to go about things. And in this video, I'm going to share with you three surprisingly simple option strategies that you can use to profit when others panic. If you're sick of just sitting on your hands every time the market turns bearish, then this is the video for you. Now, all these strategies I'm going to share with you are ones I have personal experience trading. I'm going to explain how they work, how to set them up, and their ideal outcomes. Let's start first with buying puts. So when you buy a put, what you are doing is betting on the stock price to go down. And if it does, you'll make some money. That's the high level explanation of how they work. The trickier part is actually doing it at the right time to maximize a movement like this, where you'd make a lot of money versus getting eaten up or lose money in a market that's moving upwards like this. So if we're going to do this right now, we want to have some kind of certainty that this market movement would be over, this upward movement would be kind of fading out, and the market was going to start dropping back down this way. If that's our hypothesis, then we are ready to go ahead and execute and buy a put. A lot of beginner traders love buying options like this because they are cheap and again, very easy to execute, but they are extremely difficult to get right because again, if the stock doesn't go down pretty much immediately and instead it goes this way, you're going to lose money. And so if I wanted to execute one of these trades and buy a put on the SPY right now today, what I want to do is open up my options chain there and I'll focus on the put side only. You can see at the top left-hand corner, we have a 0 day till expiration. We don't want that. That is too quick and that does not give us enough time for the stock to actually drop the way that we need it to. So I like to go out at least to the next major expiration date highlighted there in the gray. Let's go May 16th and see what that looks like. It's only 21 days away. So again, the hard part about this is that if you don't get the direction of the stock price right and it doesn't drop right away, then you're not going to be making money. You're going to lose money. But if we are in a bearish market, this is a great way to protect your account or have some insurance on your account in case the stock market does drop. So here on the put side, we'll look at puts, and I like to go above the current stock price or the SPY price of 545. There are cheaper options down here, but they are less likely to be profitable. So I like to go up here in the blue area above the current stock price. I like to find the kind of highest volume areas or option interest areas. I can see 32,000 there, 35K there. And then it just becomes a preference of how much you want to put up in the trade. Because remember, when you are buying a put, you are paying for this contract. So if I was to select the 555 put, I'd have to pay roughly, right now the mid price is 1684, so that's $1,684 to enter into this contract and purchase this put option for some downside protection. Since the market is live, these numbers will continue to update throughout the day. But if I wanted to do this and take that protection and put it on, I would just submit this trade and go like this. And that's all there is to it. Very simple, very easy. We can go check our trades and we can see here that we bought a put option at 688 and that is in our account now. We can see that in our portfolio. It's located right there, the 555 put. And ideally, once we have done this and we bought the put right there, what we want to see is the market or the stock go down. And the further it goes down, the greater our profit that we're going to lock in. So those are correlated. The drop in the price means more money for us, which is a good thing. Very straightforward, but very, very difficult to get right because, again, you need the stock to sell off and need it to happen very quickly. So time is of the essence when you're buying a put option. The next strategy that we can use to protect our account in a bear market is to sell call credit spreads. And what this involves is selling a call and buying a call option. So a bit different. We're operating on the call side of the options chain. And what we want to do or how it works is we want to pick a technical level somewhere on this chart that we absolutely don't think the price of the SPY is going to go above in the next, let's say, 20 to 30 days. So we do a quick little technical analysis tutorial and very simply, let's say we think that this level up here around this 575 area is maybe the target where we don't think the SPY is going to get to in the next 30 days. That would take us kind of all the way into the end of May, like right around here. That's our cutoff date. So if we think that the price of the SPY is going to stay below this line, which is this is a safe area, we would then go ahead and sell a call right there at 575. And then we'd go ahead and buy a call, let's say $5 to $10 above that We'll put a line up here just to show it graphically on the chart around that 580 level. And we'll just go in and execute that in our options chain in a second. But what we're betting on, again, is the price of the SPY not going up and running up and hitting this mark. If it does, we end up losing money. If it goes past it, we lose more money. If it goes past both, we have a max loss scenario. But the nice thing about this strategy is that it's a high probability of success, which I'll show you in a second. It's great for small accounts because it's not capital intensive. And the timing doesn't have to be perfect like when you're buying put options, because again, even if the price goes up a little bit, it can come up here, it can come down, go up, down. As long as it stays below this mark by our expiration date over here, we're okay. We're in good shape. We're going to make some cash in this trade, which is fine. So the timing doesn't matter as much, which is a good thing for you as the trader. Let's go over to the option chain and set this one up and show you how it works. We'll pop this guy open. We're going to keep our May 16th expiration date, so 21 days away. And now we're operating on the call side of the option chain over here on the left-hand side. So what we want to do is really look to kind of that 575 price level we looked at before, then see what our delta is at the 575 level. So going down, we can see here it's about a 14 delta, and the delta matters a lot because again, the delta is kind of like a quick little indication of your odds of the price of the SPY going up that 575 level. So with a delta of 14, there's a 14% chance roughly that the price of SPY gets up to 575. So those are pretty good odds, 86, 85% that it doesn't get there, which is what we want to see. So what we would do then to execute this, make sure that you have some kind of combo or strategy builder turned on in the bottom left-hand corner in this example. Click that guy on, go up to 575 and sell that call option right there. Then we want to go a few dollars higher to the 580 level, and we want to buy that leg and create our credit call spread. It shows up as a bear call right here. And then what we want to do one more time here just to show you a bit more is go into advanced at the bottom, margin performance. And what we can see is we have a profit probability of 82%. We have an 81% chance of a max win of $63 and only a 15% chance, again, harnessed in by that delta number roughly, of a max loss, which is around the $436 mark. So very, very high odds of making some money, very low odds of losing. If those odds work for you, you would then go ahead and transmit this price, or if you want to go back and just click the mid price, make sure you're getting the absolute best up-to-date price for the contract. You can do that as well. And you go in and you can just click submit, and it'll get your trade in the hopper as well. And just a couple things to note very quickly with this strategy is that you want to make sure you have enough volume to support the bid-ask spread being pretty tight. A couple dollars here is pretty good. $2 is pretty good. Anything like 10 cents, 15 cents, if you're getting up that high, it's going to impact the ability you have to open and close the contract at a good price. And you could experience some slippage where the price takes a bit longer or it's harder to close off your trade in the long term. So just understand that and make sure you have a good amount of healthy amount of open interest and volume to support your positions to keep those bid-ask spreads closed. And remember, with this strategy, we are not as concerned with time because, again, we have the ability for the price of the stock to go up a little bit, and the time is going to work in our favor actually this time. Instead of having to get it right and have the stock price drop immediately, like buying a put option, time is on our side. We're going to harness some time decay. And even if the stock kind of meanders or doesn't even move at all, time decay is going to chip away at our contract values, making more profit available to us for our option position. And the third strategy I'm going to show you today is selling put options. These are the probably second easiest to execute out of the three, and they are different in a way that they are very capital intense. They need you to have a bit of cash in your account. So that's not a great one if you have a small account, but if you have any more established account, let's say, these can make big time breadwinners for your portfolio. And the way that we do this is we decide on a price point on the downside, somewhere down here, where we don't think the price of the stock is going to get to again in the next, let's say, 20 to 30 days. What we want to do then, once we have that price point, let's just call it down here at the bottom of this little tick right here. Let's say around the 510 area. Let's pick 510 and put a line there just for reference, visual guide. Okay. We would then go and sell a put option at that level. We would do this because if the stock price stays higher or even drops down around that level, we get paid our contract value. That is a best case scenario. If it just stays above this line expiration, that's what we want to see. If it goes up, if it comes down, as long as it doesn't break this red line, we're okay. And we're going to make max profit on the trade, which is a good thing. However, if the stock price was to kind of drop and flatline and go underneath this, by expiration date, and on expiration date, we would get then assigned 100 shares of the SPY, which is our worst case scenario. But it's not actually that bad because you're getting a steep discount relative to where the stock price is trading at today. It's trading at 546. If we sold this put option down here at 510 today, we get a $36 or $35 discount on the price of 100 shares of SPY, which is a pretty good discount, right? It's like $3,500 off of the current price of the SPY, which is pretty good when you're looking at buying stocks on sale. So our worst case scenario isn't actually that bad as long as we do this on blue chip companies or indexes like the SPY, like the QQQ. It's when you get on the kind of more volatile or unproven companies and do this where you can run into a lot of trouble. In terms of execution, it's about as simple as buying the puts. You're just going to be flipping it around and selling them instead. So in our May 16th expiration, still 21 days away, we had that price point there around that 510 level. So we would just be scrolling down till we see the 510 area all the way down here. And you can see there's a good chunk of volume and open interest, which is great. And in this scenario, actually be getting paid $3 and let's say 20 cents or $320 to sell this contract, giving us a bit of profit as well. In case the stock price was to decline, we get the discount on the shares and we get paid 320 bucks to sell this contract today. So we kind of get a double win there if we have to end up owning the shares. If we don't, we sell this contract by clicking in here. We go sell. We select our limit price and go mid. And then we would just go and click submit. But before that, I want to show you something in the advanced tab again. We have a profit probability of 92%, and we have almost a guaranteed or a 90% chance of a max return of 314 bucks. It shows the max loss there at 50 grand. And all that means is you'd have to put up about 50 grand to buy the 100 shares of the SPY, which again is why this is a capital kind of intense strategy, not great for smaller-ish accounts. But the max loss isn't really $50,000 because there's very, very small chance that the SPY would ever go to zero because it's a makeup of the 500 companies in the US stock market. So it's not overly likely. Like there'd be other problems going on in the world. If this was to go to zero, money would be the least of our concern to that point. So it's not actually a max loss when you're looking at the SPY in this example. If you look at, again, super volatile stock that is unproven or like a pink sheet trading stock, then yes, this could be an actual like realistic max loss. So just understand to do this on blue chip stock if you want to go down this route. We would transmit this, get in the hopper, and then our portfolio, we see that we have the put that we sold right there as one. We've got the put that we bought earlier in example number one right there. And we have the bear call credit spread at the top in example number two or strategy number two right there up at the top. Now, my preferred strategy out of those three that I've shown you today is by far selling put options. I love the fact you get paid up front. I love the fact that you don't have to get the direction of the market right. I love the fact you get a steep discount if you set your strike price appropriately, well below the stock price on whatever stock or index you're trading on. So you get to own things at a discount, which is always good. The only real negative thing that you have to worry about is actually coming up with the cash to fund the position in case you get assigned shares. But again, you get them at a steep discount, you get paid, you don't have to worry about getting the direction right initially or ongoing. And they're just a very low risk, low stress way to do it when done right on blue chip companies or large index funds like the SPY. So if you enjoyed this video and you want to get a copy of my free step-by-step checklist for selling options, make sure you go to www.tradingoptionsdaily.com/checklist and grab a copy now. Thank you so much for watching, and I will see you on the next one.